Again, for those of you that have joined in, thanks for joining. Hopefully the sound is working fine. If you have any questions during the webinar, I think there is a chat box. I'll try to look at that from time to time, but you're welcome to shoot those at me. And or if not, you can text them or email them to me either during or after, and I'll be happy to follow up with you if you do have any questions. We're still a few minutes away, so we'll get started about 9 o'clock. Again, for those that have just joined, welcome this morning. We'll get started here in just 3 or 4 minutes. I think I've got the Zoom group chat box opened up. So if anybody does have any questions during the meeting, you can go to your toolbar and find that. You're welcome to type those in or send me a note later, and I'll be happy to follow up and try to answer those. Hopefully the sound's working, and we'll get started here in just a few minutes. We're about 1 minute away, so we'll give it just a minute. I see a couple people coming in yet, so we'll get started here in just a couple minutes. Got quite a bit to talk about this morning. Markets are very strong this morning out of the gate, at least corn, soybeans, and the cotton market recovering a little bit of yesterday's losses. Wheat continues to struggle, but we'll talk about some of the whys here in a minute. It's been a pretty fascinating couple of days, few days in the markets this week, and I am coming to you from southeast Missouri, actually, or southwest Missouri, excuse me. Um, and I've been visiting with some producers in this part of the country the last couple of days. So it's been good to get to visit with some people, be out and about. That's been fun, and get to talk about markets. And we've had a lot to talk about the last couple of days. Well, I'm showing 9 o'clock, so I think we've still got a few people that are coming in, and we'll admit those as they come into the meeting. But thanks everybody for joining this month. And as I was just telling the folks, we've got a lot of market movement this morning. The corn and soybean markets in particular jumping quite a bit, and we'll talk about some of the why here as we move on. So starting out with some of the highlights, yesterday was a pretty big day for crop report. We had a lot of movement, I guess, in the market in reaction to the report. We had USDA put out a record corn yield at 181.8. We had a record soybean yield at 53.3 bushels per acre. Those numbers would equate to a record soybean production at 4.425 billion bushels and would equate to the second highest corn production year we've ever had, just shy of the record previously and this year's at 15.278 billion bushels. So the supply side of things was bearish right out of the gate. The reaction was negative. We saw corn, soybean markets especially trade a little lower. Cotton traded lower as well right out of the gate. Then something changed, and we'll dig into that here as we move forward. Bottom line is ending stocks still going to be very plentiful for every crop. Forecasted old crop ending stocks, the year ends August 31st. Old crop stocks at 2.228 billion bushels of corn. That was down just slightly from last month. Soybean stocks down slightly as well at 615 million bushels. That'll be the second highest carryout we've ever had in soybeans. Wheat stocks continue above 1 billion bushels into the new marketing year. Looking ahead to new crop, stocks expected to rise in corn over 500 million bushels due to that extra production this year. There's been some talk about a 3 billion bushel carryover. We'll discuss why here when we dig into the corn market in a little bit, why that didn't happen this month, at least so far. Soybean stocks about the same, 610 million, and wheat stocks below 1 billion bushels for the first time in a few years. Now, one of the big statements that came out of yesterday's report, USDA did make this special note at the top of the page to remind everyone that the conditions for the report were as of August the 1st, that any potential impacts from severe weather like the derecho that went through Iowa this week would not be reflected in this report. So kind of gave everybody at least a calming effect, because I think we see social media kind of light up after some of these reports and people wondering, well, they didn't account for the storm damage that took place here this week. Well, they didn't have time. The report numbers were all as of the 1st of August. The Lance Koenig, who is with USDA, did also make an additional statement I read this morning that those would be noticed in the September report, September 11th. So I think the trade looks at that thinking, well, USDA will likely lower production numbers based on some of the storm damage in that September crop report. I think that's part of the reason we're seeing the bounce in futures here this morning. I did see this radar, I don't know what you call it, but it was pretty interesting to see the how the radar changed over the course of the few hours as that derecho moved west to east from South Dakota into Indiana here at the beginning of the week. And you can see the path of it. And certainly you've all seen pictures on the internet by now of grain bins, of fields laying flat. I think the guess that we're all trying to make now is, will any of those fields stand back up? Is it too late? Is is there enough water to stand them up? All of those things are continuing to be discussed, and I think that it'll be interesting to see here in a couple of weeks when the Pro Farmer Crop Tour kicks off to see what they're seeing in some of those areas, and then of course to see what USDA sees on September the 1st. Also saw this satellite map that Eric Snodgrass with Nutrient Ag Solutions put out the other day, and it does show very well some of these spots. You can see the light green where he's got arrows pointing to. Some of the light green on here apparently would reflect some of the loss in vegetative growth in some of those areas. We do have a lot of cloud cover when this picture was taken a couple of days ago, so he was suggesting when the clouds did peel back eventually, when we see these in a couple of days, we're likely to see how this, if this extends on into Illinois and maybe even into Indiana. So that'll at least be our first indication of which areas probably had the most impact. Now, as far as Monday's crop ratings went, and you can understand why, looking at the crop ratings, why we had some big numbers in the production report. 71% of the U.S. corn still rated good to excellent as of this weekend. That's pretty, just down a point from last week, but up 14 points from last year. Soybeans rated good to excellent, 74%. That went up a point from last week. We're 20 points higher than we were this time last year. Winter wheat harvest, all of the crops moving right along at a normal pace for the most part. Cotton was the one crop that did see a drop in the rating, went from 45 down to 42% in the good to excellent category this past week. One of the other big highlights here the last month or month and a half has been export sales. Here again this morning, saw some big numbers put out in the weekly report, as well as some new sales announced to China, as well as unknown this morning. But as of last week, corn and soybean sales combined for the next marketing year. Now, next marketing year starts September 1. So we've seen a really rapid pace here going back to about the middle of June. And you can see the black line on here shows that we're running at the fastest pace in the last 8 years on new crop sales. So China has really been active, and we'll discuss a little bit of why here in a minute. But the weak dollar has had a lot to do with it here in the last month or so, and China's really stepping up its game as far as buying. Some people would say, well, they needed to because of the Phase 1 trade deal. That is true. But they're no dummies. They're recognizing that with the cheaper dollar, our crops have gotten a little cheaper, and they're taking advantage of that opportunity to start refilling their stockpiles. One other note I wanted to show, and this may have something to do with the little rally we're seeing yesterday and this morning, but the managed fund position as of last week on all crops combined. This is grains, oilseeds, which includes wheat. These funds were short about 150,000 contracts combined in all of these markets. And yes, they were on the short side going into the report. Maybe the demand was better than expected, and so they're buying back some of this short position. But the one thing I've been pointing out to some groups this week, if you look at really August 1 to October 1st, or even into October, the funds usually do not trade much, if any, on the long side of the market in the row crop markets. Typically, they tend to be short this time of the year, and typically they tend to get shorter over the next 30 days or so. So I'm not real optimistic that we're going to see a sustained move to the upside. I think this is a move that you'd probably want to take advantage of if you had to move some grain here this fall. Now, if you're looking back at the fund positions, typically we get our moves after the first of the year. That's when this is the last 8 years. So typically, this is, you get into the spring, summer months, that's when we get our rallies. So if you're a producer, I don't want to be a seller here in the next 60 days. I would rather be able to hold my crop off the market if possible, and hopefully wait for some rallies here after the first of the year. If you had to move something in the fall, maybe you consider re-owning it with an option later on. Maybe buy some cheap calls, out of the money calls, something like that, in case the market does move back up later on. As far as the changes since last month, generally been lower, although I did update this just before the meeting, so to take into account the higher markets this morning. But corn has lost 3 cents. Wheat has had some big losses in the last 30 days. Cotton down almost a penny. But soybean market has kind of bucked the trend, been up 18 cents a bushel. And that's certainly been demand related, and it's certainly had a lot to do with the Chinese buying that we've seen. So let's start out looking at the corn market. These are yesterday's state numbers from USDA in the report. And you can see the darker the blue states, the bigger the change from last year. And any state with a pound sign after the number is looking at a record yield. So the U.S. yield was a record 181.8. If it holds, we've got a few states in the southeast, Georgia, South Carolina, with records projected, Tennessee, Kentucky, then on up into the upper tier with Michigan, Wisconsin, Minnesota, South Dakota, all forecasting a record corn yield. I believe Illinois is the highest, well, besides the state of Washington, Washington at a 240, Illinois at 207, Iowa at a 202, and I think a lot of folks think that number is probably going to come down a little bit with some of the storm damage that we've seen here recently. So the balance sheet yesterday, USDA did make a slight bump to the old crop export numbers, slight drop to ending stocks of 20 million bushels, not a big change. The big changes were in the new crop. We did see the yield up, production up, total supply of corn at 17.5 billion bushels. I believe that's an all-time record. But the surprising part of this was on the demand side of things. USDA bumped the feed demand about 100 million bushels. They bumped export demand over 100 million bushels. So total demand forecasted at 14.775 billion. That would be the second highest year ever, only to 2017-18. So that's pretty impressive. Just a few months back, we were talking about struggling demand. We were talking about the ethanol sector being behind, and you can see what happened with last year's ethanol grind being down. That's expected to bounce back up this year. So USDA really put out some optimistic numbers, I think, on the demand side. And if they happen, then maybe the death scenario that we were discussing a month or two ago of 3 billion bushels of corn isn't going to happen. They're still projecting over 2.7 billion. So that's still going to be a huge, huge stock number. We're not going to run out. We're going to have more stocks on hand at the end of next summer than we've had in any August 31st since 1988, to put it in perspective. So we're still going to have a lot of corn, just not quite as much as what we had originally thought, given the yield scenarios. And I think the trade this morning figuring, well, if USDA were to take another bushel out of this yield, maybe in September, maybe this stocks number starts to come down a little bit. Maybe corn might, at least for the short term, been a little bit oversold. One other number on this that we'll talk about after a bit was the farm price, the average farm price. USDA lowered it 25 cents a bushel to $3.10. So we'll discuss that when we look at PLC and ARC payments here in a little bit. Now, the reason, again, for the optimism, the last 30, 60, 45 days, I guess, has been really big for exports. U.S. corn sold in the month of July, a historic month. Usually that's not a big month for us. So it's been a big export month. We anticipate the August chart's going to look very similar. We're seeing a lot of good export numbers here again this month. The funds, as of last Friday, managed money, they're short 172,000 contracts of corn. So they were really betting on a bearish report, which they were partly right on the production side of things, but on the demand side, I think that's what's driving some of this market this morning is some of these funds buying back some of this short position that they had put on ahead of the crop report. I don't anticipate them getting long corn. I don't even anticipate them getting back to zero, but I think they're just lightening up on some of this position, given the, a little bit of optimism here with the demand side. Seasonally, we kind of go back to what we talked about a minute ago with the funds, but seasonally, this is not the time of the year to expect a rally. We tend to, in fact, see the markets trade flat over the last 20 years from August through to the beginning of October. So if you get a rally right now, probably an opportunity to take advantage of it. We'll talk about maybe a way to do that here in just a second. But again, our opportunities, best opportunities on the marketing side tend to be in that February through June, July period. And so if I can, I want to try to figure out a way to not have to be a seller today and to be able to try to wait for some sort of a rally probably after the first of the year. So looking at December corn, it's a really busy chart. I apologize for all the lines on here, but I've got these on here for a reason. You can see that, we had our COVID dip that we took back into April. The market tried to sustain at least a little bit of a rally into the early part of the summer. We sold to a new low at the end of June, but we rallied right before the 4th of July on some hot and dry conditions. We came back after the 4th of July weekend with a better forecast, and the market went south again. Went down and made a new contract low at 320. And then the last day and a half, we've seen the market start to perk back up again. We were at 333 and a half just before this meeting started when I updated the chart. So where do we go? If you look at the RSI and the stochastics at the bottom, look back a couple of days ago, especially the stochastics showed an oversold market. The RSI hadn't quite got to 30, but it was really kind of floundering. And now both those markets are kind of perking up a little bit, or both those indicators. And so the RSI at 53 would indicate probably have a little more upside. I think a few targets here. I told a group last night, the 50 and the 100-day moving averages. Those would be the gold and the purple lines. Those are at 337 and 339. Those might be some targets, and those are only 4 and 6 cents away. Another target might be this chart gap that was left back in early July. That started, the bottom of that gap is at 343. So if we're able to sustain another day or two of rally here at the end of the week, that's a dime above where we're currently at, but I think that would be an outside target to try to get to. I don't know if we can get there or not, but if we do, I think I would definitely want to be rewarding the market. I've got all these crop insurance lines on here, and I've showed these in the past, but these are to really show you how your put option within your policy, where the protection would start, assuming you ended up with an average yield. So if your yield matched your APH, or if the county yield ended up matching the expected county yield, if I bought an individual policy back in the spring, that base price that was used was $3.88. If I bought an 85% policy and my yield came in exactly at my APH, then a price below 330 corn would start to trigger an indemnity payment. Well, up until yesterday noon, or until this morning, we were below 330. So as of right now, we're maybe not in the money for some of these policies. If you added the supplemental coverage option, that 14% drop in price would take you to 334, which we're just a little bit under that right now. Margin protection insurance, we'll talk about in a little while for 21, but if you bought a margin protection policy, that price back in last fall was set at 403. And a 95% trigger on that policy, you'd only had to have the price go down to 383 to start to be in the money with an average crop. So a lot of the margin protection insurance policies, we're expecting to see some payments this year because of the drop in the price, even with some good crops. So that's kind of my thoughts on this market. Now, the strategy that I've liked in corn all year, well, first of all, before I get into that, I just wanted to put this slide out to show you where the potential downside might be in the market. And I did not update this in the last 24 hours. So the September corn, which is the lead month, is a little bit above this right now. But I just wanted to show 301 looks to be pretty good support for the corn market, for the nearby market. Right now, that's September corn. Eventually, that'll become the December contract, et cetera. If for some reason we were to break through 301, then you got to go back to 2008 when we had that low down around 290. So I have thought going into this summer, going towards fall, that there was still an outside chance of breaking through the 301 level. I think given the little bounce we've seen today, plus some of the ideas of the Iowa crop coming down some, maybe that 301 holds. But I'm not ruling out a chance of going down and eventually testing that, whether it be before the September contract expires, probably not here at the end of this month, maybe at the end of November when the December contract expires. We'll see. But the last few years, we've made our lows after August 15th. And in fact, I'd seen someone wrote on Twitter this morning that in the last 6 years, the low on December corn was not made prior to August 15th. So if you believe that that's going to happen again this year, that means the contract low in December corn still would not be made as of right now. Now, going back to strategy, this is a strategy I've liked for all of our crops this year. It's a min-max or a long put, short call strategy, partly because I've not believed that we had significant upside price risk. but I did believe we had downside price risk on a lot of these crops. And so if you go back to July 1st, July 2nd, when we bounced the December corn market, let me take my chart back here for just a second. When we bounced up here to 363 on this contract, we had the RSI got up to about 68, 69 at that point in time. And I was looking at that as an opportunity to take advantage of. We didn't know if the market was going to keep going or not, but we quickly moved into overbought situation, I think. And so that particular day, this is from our market report letter, I was suggesting buying a 340 put and selling a 390 call option for a nickel a bushel net cost. So if I would have done that, I would have had a net floor at 335 futures, which is right about where the market's at this morning. I would have had a net ceiling at 385. I think most of us would be satisfied if we had to sell corn at 385 this year, which of course I don't think will ever happen. But in this example, at least I would have had a floor under the market. And it looked really good for the last month or so. Here this morning, I've kind of updated some numbers. One suggestion would be, if you want to take advantage of the bump we've had, a 320 put option, you could buy that, sell a 360 call option, so I could have a floor at 320, a ceiling at 360, and the net cost of that trade this morning is 0. So I can sell at 360 call for the same price I'm paying for the 320 put. I think that's not a bad thing to look at, given this rally we've had. If you don't want to be a seller of corn, if we're not high enough yet where you could make money, then maybe you consider this put call strategy. And if the market goes up tomorrow, maybe you can do a 330, 370 for 0 cents or something like that. But I really like these types of strategies. I'm not concerned that the market's going to shoot off the top end. I am concerned my risk on my farm is that we go down to really cheap numbers. And if I do something like this, at least I can defend part of that downside risk. Looking ahead to next year, December 21 corn, what's really sticks out to me right now is the carry in this corn market. You've got December corn for 21 at 366. You've got the nearby September contract this morning probably trading at around 320. So about a 46-cent carry. A couple of days ago, it was over 50 cents. So for a little over a year, storing corn, it's going to pay quite a bit of money. And I'm guessing you're going to have a lot of elevators this fall, try to fill up with corn and try to hedge that corn on out into next year, maybe out into July or September, maybe not all the way out to December. Farmers can do the same thing. You know, and if I'm a producer and I've got my corn going in the bin and we get some rallies, 15, 20 cent rally, I'm probably going to be looking out at the July contract or the September contract next year as a place to start locking in price. And then, you know, hold your corn until you get out there, look to set the basis when we get some good opportunities at some point in the year, and then lock it in and haul it at that point in time. But that's really the way you make money in these big crop markets, is you have to earn the carry. The only way to do that truly is to forward sell. Because what happens if we get out to next summer and we're still sitting on 2.7 billion carryover and we've raised 91, 92 million acres of corn and it looks decent? You know, you're going to see nearby corn prices back down to where they were here this summer. And so I want to take advantage of rallies, sell the carry, and lock in that money. Now for next year, I'm probably not ready to sell at this price level yet. I think 380 seems like a good place to get started. That was the high back in early July. That was also the price that we had discussed with a power play that Watson Associates had put out about a month ago. And we were looking at a way to lock in that price up around that 380 level for your crop insurance for next year. So I think that 380 mark is a pretty good mark. It's also a little bit below the 200-day moving average, this turquoise blue line at about 385. So if we get up around that 380 level, I think I'm going to start to trickle off some sales for next year's crop. The soybean market, we had a lot of states looking at record bean yields. Of course, nationally, we're looking at a record 53.3 bushels per acre. We had South Dakota, Nebraska, Missouri, Illinois, Michigan, Indiana, Ohio, Kentucky, Mississippi, all forecasted right now to have a record bean yield this year. And these dark blue states up substantially from last year. Georgia up 27 bushels, South Carolina up 23, Illinois up 18.5, Indiana 19, so Michigan 25, 26. So a lot of states with some much bigger bean projections here this year. And the balance sheet from USDA reflected that in the supply. They're telling us we're going to have over 5 billion bushels of beans available this year. First time ever. That's pretty remarkable to think that we'll have that much supply available. So why is the market up? That's the million-dollar question. Well, the reason the market's up is demand. And USDA is forecasting demand, total demand, at 4.445 billion bushels. They raised the crush number. They raised the export number based on the Chinese buying that we've seen over the last 45 days or so. So what's really incredible to me, even though stocks are big at 610 million bushels, if you look back at supply, look at the acres. We increased acreage, 7.7 million acres this year. We had yield up 6 bushels. Production was up 900 million bushels, yet stocks remained unchanged. I think that's pretty remarkable if that's able to happen. So even, you know, working through a record bean crop, we're still able to hold stocks the same. So that's where the optimism is coming from. It's on the demand side of things. USDA did drop its average farm price 15 cents a bushel down to 8.35. We'll talk about that here in a little bit. But you look at China imports, they're back. You know, for the last year or so, we've been kind of lamenting the fact that China was out of the bean market, or not near as prevalent as they had been. They had fought through the African swine fever issue and had culled a lot of pigs, and so it took time to build their inventory back up. Finally got to the point now where they're trying to refill their stockpiles. During the COVID outbreak in the early months, they had not brought any beans into the country, and so they've been very active buying Brazilian beans here in May, June, July, and shipping the heck out of them. And we're expecting that to happen here once we get to the new crop year out of the United States. And a big reason they've come back to the U.S., of course, is the U.S. dollar. And I told the group last night, Chinese are not stupid people. They're pretty savvy traders. And it just so happens that right about the 1st of July is when they started really buying a lot of U.S. soybeans. And that coincides with when the dollar started to fall. And so they didn't buy beans back in the spring, of course, but now that the dollar has fallen, prices really haven't changed a whole lot domestically here. But with the dollar down, it's made our beans a lot cheaper. And so they continue to buy. They've bought beans 5 straight days now. Last week's sales were over 3 million metric tons, a huge week last week. So we would expect this August number to be just as big as that July number when we get that chart here in a few weeks. So here's the July, record July sales. And most of that is for new crop, but still, you know, that's good to see, and the markets needed it. Funds going into the crop report were long about 44,000 contracts. Actually, this is as of the middle of last week. So they were sellers over those few days. So I know that they did sell off some of this length. And that's probably why they've bought a little bit of it back here the last couple of days. Probably buying back. Maybe they regretted selling what they did, and now they've bought back a little bit of what they sold over the last few days. And one thing that's different about beans than corn, you know, corn really shows a tendency of the funds to be either short or neutral from now through fall. But beans, they're kind of all over the place historically, even all year long. And the beans just are not as seasonal of a market as what corn is. I think that's really what I gleaned from this. And you've got crops coming off every 6 months in a different hemisphere. You've got a very active world buyer that we don't necessarily have in corn. Corn's kind of hit and miss around the world. So the beans tend to be, you know, don't have the seasonality anymore of what the corn market does. Here's our November bean futures chart. Been a nice little up move since the COVID low back in April. We've got a trend line that I've drawn. Now, we did bust through that here for a few days. We kind of dug our heels in at this 100-day moving average line, just around the 870 or 865, just a little bit below it. We did trade down, but you can see that the stochastics especially turned higher. And yesterday, the old red line cross the blue line thing, the technical buying signal, probably signal for buyers to get back in this market. And so you've seen a quick jump at the end of the day yesterday, followed by another quick jump today. We've broken through all of these moving averages, the 9, the 40, the 20-day moving average, the 50 was the gold line. And now I think we're setting our sights again on this 200-day moving average, which has been a target of mine for a month or so now. Which is at 903 today. And I think you get back up around that level, probably a good place to reward the bean market, which is a dime above where we're currently sitting. Also watch the RSI, quickly got up to about 55, 56 last night or this morning. We've had it only twice this year, clear back on the 1st of January, and then here at the beginning of July that the RSI has actually touched the 70 level. So if we get back up into the upper 60s, if I need cash this fall, I think this is a good opportunity to be doing some bean marketing. And unlike corn, beans do not have a carry in the market. There's no incentive to store. The futures market's pretty flat on out into 2021. So, you know, the market is really telling you to sell your beans. If you want to re-own them, go buy a call or something. But there's no incentive right now to hold soybeans in the bin. And similarly to corn, I've liked that same strategy of buying a put and selling a call. This is what I had put out in the market report back at the 2nd of July. That day, we were looking at buying an $8.80 put, selling a $9.60 call. The net cost of that trade would have been 2 cents a bushel. Today, what I'm looking at is buying an $8.80 put. If I want to take advantage of the rally, I could sell a $9.20 call, and the net cost of that is 1 cent this morning. So if I think that there's a chance that maybe this bean market's getting overdone, I want to put a floor under it at 880, which is right here about where this red line is. If I'm willing to take a ceiling at 920, which is up above the July high, basically saying I'd be willing to sell beans at 920 if I got stopped out. But if they go back down, at least I know I've got a floor under it. Only cost me a penny to put that on. Otherwise, if I don't do anything at all, I'm at the risk of the market. And do I believe beans can rally sharply? I don't know ahead of harvest. That seems like a big stretch, especially if we're going to raise or harvest a 4.4 billion bushel bean crop, put it all in the bin. And the other thing, we've got an election coming up. We've got this somewhat tenuous relationship with the Chinese. And even though they're contracting all these beans for new crop delivery, have we ever seen the Chinese cancel purchases before? Absolutely. So if something changes political, if the political winds move, something, you know, weird happens, you know, for a penny a bushel, it's a pretty good place to put on a floor, at least from now till late October. Or you could go out to the January contracts and do the same thing there. So I don't think it's a bad way to at least defend the market just in case something does happen. Finally, looking ahead to next year, we're nice little uptrend in the bean market for 21. We've reached my goal. My goal was to start doing some hedging at $9. We're at $9.04 this morning, just underneath the early month high. So I don't think it's a horrible place to start trickling off a few sales. Keep in mind what can happen next year. You know, we talked about the political side of things. Brazil is expected right now to raise 3% more bean acres next year. Going to be a record production or record acreage. Forecasts are for a record crop already out of Brazil next year. So who knows? It's a long way to go before they harvest beans. But again, look at the RSI is at 62. Stochastics are moving up a little bit. Maybe there's a little upside in this market, but I think I'd have my selling shoes ready. You can see that we've had a few times where the RSI has peaked out this year over 70. And so again, I think that's a good number to look at. Maybe tomorrow, if the market extends its little bump here into Friday, might not be a bad place to start doing a little hedging for next year. The cotton market, cotton got a real curveball thrown at it yesterday from USDA. We'll talk about that here in a second, but the yield numbers, USDA is forecasting a record yield in cotton at 938 pounds. That's up 14 pounds from last year. You can see the states that are looking at records. Mississippi at 1240, Arkansas at 1195, and a few other states up dramatically from last year, including the southwestern states and the Delta states, even the southeast states, Georgia and South Carolina, up from a year ago. So why was the market what was the big loop that we got thrown? Well, it was acreage. USDA came in yesterday and lowered its harvested acreage number by 1 million acres. It, in, and I don't have the updated balance sheet here. I apologize. This is last month's. They dropped this harvested acreage number to 9.25 million acres. That was a 10% drop in harvested acres. Took the yield up to 938 from 820. So remarkable change there. Took production up to nearly 18.1 million bales. So the only thing I can gather is they must have been taking a lot of dry land acres out of the equation. That's what I can figure. And if by doing so, then that took the yield way up on all the other acres that were irrigated and in better shape. So I haven't seen any explanation. That has to be what happened. I just don't recall a time we've ever seen that dramatic of a change in the acreage and in the yield numbers in the cotton market. They made a few other tweaks to the balance sheet, but the bottom line was ending stocks went from 6.8 up to 7.6 million bales of cotton, which to my knowledge would be a record high ending stock number here in the United States. And they did take the average farm price down a half cent to 58.5 cents. So the cotton market yesterday did drop as expected. We fell back down really to just the recent lows. And this morning we were back up a little bit. So, kind of resilient, I think, given all that change in the numbers yesterday on the production side of things. The relative strength index and the stochastics both would really show a neutral type market right now. It's 62 to 63 cents. We're sitting right in the middle of the trading range we've been for the last 45 days. We're right in the middle of all these moving average lines. The 20-day moving average is just about where we're sitting. We've got the 9 and the 200 above us. We've got the 100 or the 50 and the 100-day below us. So I don't really see this market going anywhere right now. 65-cent recent high, I guess, if I had to be a seller. We did have the RSI up over 70 the last time we got to 64.9 back in early July. RSI got in the upper 60s at 65 cents. So if we get back up close to 65 cents and I needed to move some cotton this fall, probably be a good place to be a seller. The other thing I'd point out here is all the crop insurance lines. If you bought the supplemental coverage on top of your policy this year, your individual policy, you would have an 86% trigger. So depending on what your yields look like from a price perspective, that would be at 60 cents. So we're a couple, 2.5 cents above that level right now. So just some things to consider here as we go forward. Kind of like the other crops, I've liked that strategy of buying a put and selling a call. I don't think there's a tremendous upside potential, but this was what I had written about back on July the 2nd, was buying a 63-cent put, selling a 65-cent call. The net cost of that was a half cent at that time. And again, if you go back and look at where we're at today, we're 62.5. So I would have had a floor at 62.5. So today you could probably do something similar, maybe not quite as good, but that would still be something I might look at just in case the government comes in and makes some drastic changes again in September. Looking ahead to next year, pretty good uptrend here. And not sure what's sustaining that other than the market was way oversold back in April. The COVID outbreak really shut down the export market to Asia and really put us on our heels there. But since then, I think things have kind of opened back up a little bit. We've seen a little bit of Asian buying. We've got a nice little uptrend built. And as long as that thing holds, I'm not going to panic in this market. The 100-day moving average kind of going right along with it. The 50-day moving average at 61.6 cents. So that looks like pretty good support. We're still trading above these shorter term moving average lines as well. So they're kind of pointing to the upside. So I'm going to sit tight here for a minute. I don't know what's going to happen with acres next year. I would tend to think that we might try to increase acreage of cotton, but then again, why? If prices are in the low 60s compared to some of the other crops, I'm not so sure that that's a overly attractive deal either. I do think I'm going to watch the indicators at the bottom of the screen, the RSI and the stochastics. If we get back up around 70 in the RSI, like we've done a couple of times, then maybe I look at an option type strategy like the one I just talked about. Maybe you look at buying a 63-cent put, selling a 66, 67-cent call, as a way to at least set a floor, take a ceiling, but at least put a floor into the market. Finally, wheat. Wheat had a lot of small changes in yesterday's report on the production side. Here are the winter wheat yields. Generally versus last year, we're either close or down some from a year ago. So nothing real major there. But what we did see was an increase in the spring and the durum wheat numbers. And USDA forecasting a record spring wheat yield of 49 bushels per acre. The blue states are all above last year. Montana would have a record high at 40 bushels per acre if that does happen. And durum, same way. We've seen a big jump from last year in both Montana and North Dakota, and a pretty good durum number there as well. So the bottom line was USDA did raise its overall yield 0.4 of a bushel an acre, did raise production some as well. But the positives were a decrease in imports and an increase in exports. And that took ending stocks down about 20 million bushels to 925 million. And guess what? That's the first year that we'll be below 1 billion bushels since 2016. So that's a step in the right direction. It's taken a huge cut in acres to get us there. But from the U.S. perspective, things are starting to look a little bit better. Now, why is the wheat market not going up? Well, it all has to do with the world numbers. World numbers continue to be bearish. We're seeing world production, another rebound year with the former Soviet Union, Europe, Australia, all bouncing back from where they had been down a couple years ago. And world ending stocks are projected to be at an all-time high this year. So that's kind of taking the bloom off of what was a better looking situation here in the U.S. So Minneapolis wheat continues to trade a little lower. That was driven yesterday by the higher projections in the upper Midwestern states, in the Northwest. But I think this market's probably oversold. I think we've probably done enough damage to it for now. The stochastics especially would indicate an oversold market. RSI is down in the 30s right now and started to turn higher. We did actually trade a little bit higher in this market this morning. So maybe it's just a dead cat bounce. I'm not sure. As far as a target for pricing, I'm probably going to be looking at the gold and the purple lines, which are the 50 and the 100-day moving average. And if we get back up to those levels, 20 to 30 cents higher, I'd be laying off some price risk. Otherwise, I'm probably just going to sit tight if I can. Chicago wheat, I'm looking ahead to next July now because we are moving into the crop insurance mode and we're getting ready to think about next year. And so this market has taken a big hit over the last half month. And really that's been driven by better conditions in Europe and more competition in the export market. But as with Minneapolis wheat, I think we're oversold right now. The stochastics and the RSI would indicate this market's probably overdone. Quickly moved there from having the RSI at 70 just back here in the middle of July. So today I don't want to panic sell, but I think I would look at some targets such as the purple line, the 100-day moving average at 535, and then the 200-day at 544. Those to me look like some excellent pricing targets. And if we get back up near those levels, I would imagine you're going to be looking at the indicators at the bottom of the chart, probably telling you it's time to be making some sales. So those would be a couple of targets for me. Kansas City wheat, pretty similar chart, although we did make a new contract low here this month. We're pushing to get through the 9-day moving average this morning. If we're able to do that, and I think we probably can given the oversold status of the market, I'm going to look at the 50-day moving average at 479. It's about 20 cents above the market today. And then the next line is the 100-day moving average at 494, which is just below the July high. Those would be a couple of targets I would have for pricing next year's wheat. With that, I'm going to slide on into revenue insurance, and we've got a few different topics to talk about. I continue to make this point every month that your revenue insurance policy really consists of 3 different options. I talk a lot about the commodity options and using puts and calls, but your revenue policy really contains a price put option. And we discussed that with corn, and I showed it with cotton as well. And if the price drops far enough, you're going to get paid because of a revenue loss that's been driven by price. Your policy contains a yield put option. Essentially, that's your multi-peril price yield trigger. That if you buy an 80% policy and you fall below 80% of your APH, you're going to get paid on those lost bushels. And the other option is a call option. And that means if you have that yield loss and if the price goes up, you get paid at that higher price. So you get price movement to the upside, you get price movement to the downside, you get yield to the downside, all three of those options are included in a revenue policy. So we are in the harvest pricing period in some of the deep southern states, as well as in the northwestern states and the upper Midwest for spring wheat and barley. And you can see where we're at on setting those prices right now. We're not quite halfway through the month of August. But one thing I would point out is that down at the very bottom of this, I show the price change from what the base price was back when it was set in the spring. And you've got crops like corn in Alabama, Florida, Georgia, Louisiana, down 20.5% from where the base price was set. So assuming that holds, you know, depending on your coverage level, we could see some indemnity payments because of the price drop in the price of over 20%. If you had an 80% policy and you raised a yield exactly at your APH, right now you'd be in the money for an indemnity loss because of the drop in the price. Sorghum, pretty close to the same numbers as well. We're down about 18%. Barley's down about 19%. So kind of keep an eye on this. If you're in these states, I would be, and you're a producer, I'd be talking to my agent, try to find out what my trigger on yield would be if the price ends up at these levels here at the end of the month. Other southern states will start setting their harvest prices here in September on the 1st, and then the rest of the states will start setting theirs in October. Looking ahead, next week we will start to set prices for next year's 2021 winter wheat. And so here's my blank table, all waiting for the numbers to get plugged in. I've got last year's base prices at 486, 494, 435, 448. We're a little bit above those levels right now. So we'll see where we end up starting at next Monday. And margin protection insurance. We're going to start setting base prices for those policies as well next Monday. Margin protection is available for 2021 for corn, soybeans, and spring wheat in certain states. The thing that made margin protection very attractive this year was that last year that price of corn was set at 403, beans were at 932, and wheat was at 551. And guess what? We're not anywhere close to those levels. Well, beans aren't too far below, but the other crops have fallen pretty hard from those levels as well. Margin protection also includes input costs for urea, DAP, potash, diesel, and interest rates. So those will all determine their base prices here during the months of beginning of, or end of August, 1st to September as well. But I wanted to go back, and I've had some questions. People have asked, what part does the input cost matter in a margin protection policy? And historically, it matters just a little bit. I'll just say that. Doesn't matter a lot in the big picture, because when you look at the expenses, now margin, by definition, you're insuring a margin. You're not insuring a revenue. So what margin protection insurance does, for those not familiar, it takes your typical revenue policy and then brings in input costs and subtracts those to create a margin. You're insuring that margin at the end of the year. And if the margin drops, then you get paid. This is a county level policy. So it's looking at the county averages on yield. And this goes back to 2018. This is our calculator that we use. And I ran these all for Sangamon County, Illinois. But just to really show you how the input costs matter, the expected cost that year was $307 an acre on corn. The final cost was $321. Some of these inputs like urea went up a little bit, DAP went up a little bit, diesel went up a little bit that year. So the inputs went up some. The variable input costs, these 5 are considered to be the variable input costs. Those amount to about 1/3 of the total expense. The other costs, not subject to change, those are considered to be fixed costs. So you can see these, even though these all went up some, in the big picture, it wasn't a huge amount. The total expenses went from 307 to 321, which was about a 4.6% increase in the expenses. So yes, it does impact the policy some. In this example, it actually went against the policy because the costs, it helped the policy. The costs went up, therefore your coverage, you were closer to being able to trigger a loss because of the increase in the input costs. Now this year in Sangamon County, Illinois, the expected yield was 197 and the final yield was 235. That's why there was no payment. We had a record crop that year in Sangamon County, Illinois, and the price of corn didn't fall far enough to end up triggering a loss in revenue. Fast forward to 2019, the second year, full year that we had this policy, input costs dropped a little bit. We saw the the urea costs go down. DAP went down substantially. Diesel dropped just a freckle. So input costs dropped 4.5%. Did it matter? A little bit, maybe. But that year, the price didn't go down. In 2019, the price only went down a nickel. So we didn't lose a very big percentage, and the yield went up just a fraction. So we didn't quite have enough to have a 5% loss in margin that year in order to trigger a payment, even at the 95% level. 2020, this is the year we're in right now, and I showed you the chart earlier. I took out the light green lines just to show you the margin protection lines. But as of today, we're down somewhere between 15 and 20% on price from the base price being set back at 403. And so even if prices, if they hang around in this area, what does it mean in the calculator? Well, I plugged in 323 up here as a harvest price. The inputs actually did drop a little bit this year. The only one that did was diesel fuel, and everything else the government kept the same, but diesel fell dramatically. This was set during the month of April when the COVID outbreak hit. That's when diesel and fuel prices fell pretty sharply. So the inputs fell a little bit, equated to about 3.8%. So what does it mean for the policy? Well, even with those inputs down slightly, if the county yield were unchanged, because of the drop in the price, we're looking at a potential indemnity payment in this county of $142 an acre. Okay, I think most of us agree that the yields might be up a little bit. So I ran this again using a 230 yield in Sangamon County. And even in that instance, we're looking at about $100 an acre indemnity payment. So this policy, the big advantage to the policy is the 95% trigger. You only have to have a 5% loss in margin in order to start to get a payment. The other advantage is this protection factor of 120. If there's a loss in margin, you get paid 1.2 times the amount that gets lost. So when there's a payment, the payments get escalated fairly quickly because of that protection factor. You don't have to buy that up to 120. You can buy it down to 100. You can even buy it less than $1 for dollar. But when it pays, it tends to pay fairly well. And so even this year with the input costs going down slightly because of diesel dropping, in the big picture, it didn't make that big a difference. So producers that bought this policy, certainly we're going to be watching where the price ends up here in October. If the price goes up in the meantime, it kind of works against the policy. It works for you, though, on the grain that you don't have sold. But the other number we're going to be watching is yields, and we'll get those yields out into the spring of next year. So for 21, we're going to start setting the prices, as I mentioned here next week. 366 is where we're at right now. That's not near as high as we were a year ago at this time. But again, keep in mind what happens if. What if we have 2.7 billion carryover next August 31st? And if we've got a decent crop at this time next year, you could be looking at prices. We got September corn traded down, or May corn traded down to 301 this spring. You could take corn back down into those low 3 numbers. And if that happens, having this price set at 366 or give or take wherever it ends up being set may not be a bad deal. And so we'll be watching this pretty closely over the next month as we set these prices. I'll be glad to answer any questions you've got. In the meantime, we'll continue to update these prices for you in the market report letter in the afternoon and kind of keep you up to date on what things look like. One other thing on insurance I wanted to mention was a power play that was sent out here at the beginning of this month on August the 3rd. And Watts, who we partner with on some of our programs like our Powered, had suggested that when we traded November soybeans of 21 up near the $9 mark, that it wasn't a bad place to start looking at locking some of that in for your crop insurance for next year. We can do that with this our Powered program. And Watts gave us some pretty good historical numbers here. When you look at the 10-year seasonal pattern November soybeans, the highs in November beans get made usually in late July. And so this was just about the time the market was making its peak here a couple, 3 weeks ago. And so they were considering buying this R Powered, which would lock in that particular day. It was 898 3/4. Lock that in as a minimum for next year's crop insurance price. So either A, If the February average does not reach 898 3/4, you're going to get to use that as your insurance price. If it goes above that level, then you just walk away from this and you get to use that higher price in February. So it's basically like buying a put option on your crop insurance right now. The net cost of that by itself equated to about 9 cents a bushel. So when you look at options in the marketplace, they're quite a bit higher. Of course, when you do it in the marketplace, you get the opportunity to trade out of them. Here you don't. This is basically locking in that as a floor. You could also have added the May, June, and July time frame for next summer, which we call through this R-powered as well. And so if you did do that, the additional cost of that would have been equated to about 3 cents a bushel. So then you would have had the alternative pricing periods of May, June, July. You would have had today's price at 898 3/4. You'd have had the February average, and you'd have had the fall price. So you'd have had a lot of different opportunities to have a decent price on your policy. Here's where it was back on that at that time frame. Here's where we're at today, 901.5. So if you wanted to do this, I'm sure we could still do it. We're back at those levels once again. And for folks that, if you want to lock in a floor for next year, you can get that done today. So just wanted to mention that it's available once again. Talk to your NAU Country agent, and we can get you a quote if you're interested in doing that. Farm program update. USDA made a lot of changes to its prices yesterday, not for the old crop. The marketing year that we're currently in will end on August 31st. That's this gold column on the left, and they did not make any changes to those prices. Every one of the crops that's highlighted in gold would currently be low enough to be triggering a PLC payment for this year. PLC triggers when this price is below the blue price on the left-hand side. And the way PLC works, you get paid the difference in that price times your payment yield at FSA times 85% of your base acres. It's on base acres. It's not on the acres that you plant. So right now we're looking like we're going to get quite a few PLC payments for most crops other than soybeans here for this year. The wheat price was final. It was set here at the end of June at $4.58. So we know we're going to get a payment on wheat. What USDA did do was change a bunch of the new crop estimates for next year. Now, these prices actually don't start being set until September 1, and they go all the way through next August 31st. But these are the projected prices from USDA for next year. They dropped the corn price 25 cents a bushel. They dropped beans 15 cents. They dropped wheat a dime. Took sorghum down, I believe, 25 cents. So at the end of the day, we're looking at some significant PLC payments potentially out into 21 for some of these crops. If you're in the ARC program, ARC is using these benchmark prices in these boxes on the right-hand side. So let's take a look at some examples, which I've been showing at all of these during these webinars. 2019 PLC for wheat, we know that payment was going to be 92 cents a bushel. So if you had your wheat in the PLC program, you're going to get 92 cents times your payment yield at FSA times 85% of my wheat base. I'd be getting about $31 an acre in this example, depending on where my program yield is. The other thing I'll mention, if you do elect PLC, you are eligible to add the supplemental coverage option to your insurance policy. I mentioned earlier, SCO starts at 86%. It's a county level coverage, and it covers down to your individual level of protection. So if I'm buying a 75% revenue policy on wheat, I can add 11 points of SCO coverage based on my county. It is a county-based product. It's not available if you enroll in the ARC program because SCO and ARC are very similar. ARC is a county-based program through the FSA office. SCO is county-based, but they're both 86% triggers. They don't let you double up on the county coverage, but they will let you buy SCO if you enroll in PLC, and SCO is subsidized at about 2/3. Makes it pretty cheap way to get some additional dollars of coverage onto your policy. For corn, as of right now, if we end up at 360, we're going to get a dime. Take that times your payment yield times 85% of my base acres. This example, I'd be getting $12 to $13 an acre. For sorghum, if the year ends at 325, we're going to get 70 cents a bushel. Take that times your payment yield times 85%. I'd be getting around $40, almost $50 an acre in this example. For the ARC program, if I enrolled in ARC, ARC is the area revenue coverage, And so many of us did do that. We signed up, that initial sign up for the 19 and the 20 years, we may have enrolled in the ARC program. If you did, I'm backing into what would have to happen here in order to trigger a payment. And I used a fictitious county, but let's say that this county had a 150 5-year Olympic average yield. We know that the benchmark price starting out was at 370. That gives us our benchmark revenue in the county of $555. The trigger is 86% of that, or $477 an acre. The government's telling us right now that the estimated price is going to be 360 this year. If I divide that into 477, I come up with a trigger yield at 132.5 for the county. So I know that at this point, if that price holds, my county would have had to have a loss of 17.5 bushels in order to start to trigger a payment. The good news is we have folks like FarmDoc who did this work for us, and they've put together this map with the price at 350, which we're at 360 now, so these don't quite match up, but they did this a couple, 3 months ago. This is where we would have been projecting some ARC payments for last year. If you're in the dark green boxes, probably not as much at 360. We can go do the math, but there would be probably some payment for last year. So we know there's going to be some scattered payments around the country. For soybeans, one of the things that made the ARC program attractive for beans, and one of the reasons that we discussed doing this, is that ARC at least gave you a chance to get a payment. PLC, you would have had to have this price go below 840 to get paid, which we're not going to see that happen. So ARC might, because we started with a high benchmark price at 963. We take that times our 5-year Olympic average yield, gives us our benchmark in the county times 86%, gives us our benchmark or our county trigger. Divide 855 into that, tells me that we only had to have a 1.6 bushel loss in the county yield last year to start to trigger a potential payment. Here's what it looks like on the map. At 850 beans, we have a lot of counties around the country that would be triggering ARC payments, where they would not be getting a PLC payment this year. So we'll see. We'll see where that final price ends up here. Those prices will be published in the September crop report, which will be on September the 11th. And so those ought to be the numbers that we can plug into this equation to determine how much those payments might be. So for 2020, what's it look like? Keep in mind, when you signed up for this program initially, it was a 2-year sign up. It was for the 19 and the 20 crop years. Next year, starting in 21, you'll get to choose your decision. In other words, you'll get to re-elect a program each year for the next 3 years. That'll have to be done, I believe, by March 15th. Initially, when we had this sign up, we got to see most of the crop year for the first year. So that's what dictated, I think, for a lot of us, whether we signed up for ARC or PLC for the 19 and 20 years. So whatever you signed up for in 19, you're in it again for 20. After that, you'll get to re-elect a program. But if you're in the PLC program for wheat, right now, given the government's forecasted price at 450, we'd be getting $1 a bushel. Take that times your payment yield times 85%, gives you your payment. And keep in mind, you didn't have to plant any wheat that year. You just had to have wheat base in order to qualify for the payment. For corn, because USDA dropped this market year average estimate 25 cents yesterday, that would take the prospective payment up to 60 cents a bushel. Times your payment yield times 85%. In this example, I'd be getting over $76 an acre. So I would expect this price is going to change, of course, over the next 12 months. But kind of keep this in mind, that if prices stay where they're at, you do have some support from this PLC program. And maybe that's another reason I like using the option type trades to protect price movement where we're at today, and maybe not jump on a limb and be selling a bunch of corn here, because I do have protection also with this PLC program. The sorghum program, 310 price would give me an 85-cent payment. In this example, it'd be $57 an acre. Cotton seed, this is not an updated price. The USDA will put this out probably in a couple of days. This is last month's price, but right now we're looking at 7 1/3 cents times my payment yield times 85% of my base acres. Still looking at over $100 an acre potentially on cottonseed payments for last year. So, or for this coming year, excuse me. So we're looking at significant payments as we go ahead, and I think that's important to keep in mind when you're thinking about your overall revenue management on your farm. And we're working on a tool to be able to display that for everyone, but your crop insurance is part of your revenue, your marketing is part of your revenue, your government program payments are part of it. They all three work together, and you're going to need all three parts of those in order to try to maximize your revenue here as we go forward. So as I mentioned, we're working on a tool to be able to display that and hopefully have that ready for you here this winter. Soybeans, I forgot I put soybeans in because as of last night, or as of yesterday, USDA forecasting an $8.35 price would give us a nickel payment. And if you do the math, you'd get a $1.70 PLC payment. So not expected to be much, if any. I wouldn't spend it all in one place, but nonetheless, or you might have to spend it all in one place. But nonetheless, with prices where they're at, we're just below the trigger line for PLC. So in closing, we've got some important dates coming up. Starting on Monday, we set our base prices for winter wheat. I didn't also mention margin protection insurance as well. The end of this month is the end of the marketing year. So after that, we'll get the final prices that will be used for PLC and ARC. September 11th is our next USDA report. And then on Monday, the 14th, I'll be hosting the webinar, the afterMATH webinar. This webinar, we'll talk about the changes in that report, the impact on the markets, and what may be in store here as we go into the harvest period. September 30th will be our sales closing date for both winter wheat as well as margin protection insurance for corn, soybeans, and spring wheat. So just over a month and a half away from today. Don't forget, we've got a lot of different marketing market sources of information that are available to you. For agents that are on the call, they're available to your customers. The opening bell phone call is the call that I put out every morning at 8:35. It comes to you a couple minutes after that. It's a 2-minute phone blast with a market update, what's going on and why. The market report is a letter I send out every afternoon by email, try to give you an update on what the markets are doing. This is where I'll put in those put and call strategy suggestions. You know, when the market rallies, when we get the RSI up into the 60s, 70, then's the time to be doing some action. And so that's when I'll write about what could you potentially do here if you're looking at defending prices. The afterMATH webinar this morning, Kicking Up Dust is a podcast that I'll record, I don't know, every couple of weeks. I did one last night, so you can go check it out. It's on Podbean if you want to subscribe. Or we do include that on our agent portal and farmer portal through the NAU Country website. You can go check them all out through there. Crop Scout Insights is a bi-weekly letter that we compile crop ratings from folks across about 23 states. They're gracious enough to spend their time and give me comments on what the crops look like and some ratings. Some send pictures. So if you want to see what's happening in other parts of the country, check that out. It's an email letter that I send with the market report every other week. And we've got our, in addition, our website. You can check out revenue prices, commodity prices, etc. I also want to give a plug out for Field Insights. I was in meetings this week, and one of our marketing representatives was given an in-depth description of this program. It's a phenomenal program. So much weather information, so much predictive weather information. If you're looking at spraying, if you're looking at when your crops might be at 22% to start harvesting corn, you can calculate all this within this thing. You can look at, of course, daily weather. You can look at soil conditions. You can, it's got all your farms plugged into it. You could actually do a pre-acreage report on this by going in and labeling your farms on the left-hand side of the screen. You can see each of the farms. You can go label the farm corn, beans throughout the spring period. When you get ready to do your acreage report, you've already got them labeled. So all you have to do is check, make sure the acres are right, make sure the crops are right, sign it, you're done. So there's a lot of neat things with this Field Insights. Young producers probably would eat this stuff up. I like it just from the weather standpoint. I look at my dad's farms and see what where he got rain, which fields he could probably work on, which ones he can't. And so I glean a lot from that as well. So I would encourage you to check into this, talk to your representative, and see about getting set up. So with that, I thank everybody for joining. If you've got any questions, feel free to shoot me an email after this, and I'll be glad to address them. I appreciate the opportunity to visit with you, and hope you have a happy and safe month ahead, and we'll look forward to talking to you again next month. Thanks.